What's up guys, and welcome back to Wall Street Millennial. If you're new to this channel, we cover the Wall Street Bets forum and other topics related to stocks and investments. In this video, we're going to explain implied volatility of options and what it means for options trading. Implied volatility is the market's forecast of a stock's future price volatility. Implied volatility impacts the price of options because the greater the volatility of a stock, the more likely it is to exceed the strike price. For example, a high-flying stock like NIO is much more likely to have large price swings, so if you own a call option with a strike price 20% above the current stock price, there's a pretty decent chance it will expire in the money, and this makes the option worth a lot. On the other hand, take a sluggish stock like Duke Energy. The share price doesn't move much, so if the strike price is 20% above the current share price, you have a slim chance of ending up in the money, so the value of the option is very low. Implied volatility can be analyzed using the Black-Scholes model for options pricing. According to Black-Scholes, the value of the option is a function of the current stock price, the strike price of an option, the time till expiry, and the volatility of the stock. Due to the convexity of the payout of an option with respect to time, higher volatility of a stock price always means higher value of the option. As a result, when holding all other parameters constant, if you know the value of an option, you can infer the volatility of the stock used to calculate the price of the option. You can see this in practice if you look at the option prices for volatile stocks compared to stocks that don't move very much. If we look back at Duke Energy and NIO, notice that even though Duke Energy's stock price is almost twice as much as NIO, the at-the-money call on Duke Energy, expiring on December 18th, is only about half the price of the at-the-money call on NIO with the same expiry date. This is because the volatility of NIO is so much greater that the upside potential gains for NIO is much more, whereas the increased downside risk associated with the greater volatility of NIO is capped because these are calls, not stocks. So what does this mean for trading options? You have to keep in mind when you buy an option, the higher the implied volatility, the greater the premium you are paying to buy the option. For an option with high implied volatility, the stock has to go up a lot for your call to make money, and vice versa for a put. Taking for example NIO, the implied volatility is 108% and the strike price is $49, but the break-even price is $54.80, more than 10% higher than the strike price. So the stock has to move up higher than the break-even price for you to even make a profit, because you have to make back the premium that you paid. So the greatest upside you can get is for an option with low implied volatility and therefore a low premium. If you can find a stock like Duke Energy that is perceived to be boring, but in reality has a lot of upside, this is how you can make money because you can buy the option with a low premium and keep more of the upside as profit. So when you're looking for investments, it is often best to look at boring stocks with low implied volatility. If you can find one of these stocks that actually has a catalyst or some other reason it will move up quickly to the upside or downside, such as earnings, this is where you can make a lot of money. Alright guys, that wraps it up for this video. If you liked it, make sure to leave a like and subscribe, and we'll be back next time. Wall Street Millennial, signing out.